Hello, and welcome to Virtual Investor Conferences. My name is Matt Lateplo, and on behalf of OTC Markets, we're very pleased you have joined us for our next live presentation from Anfield Energy, Inc. Please note, you can submit questions in the box to the left of the slides. You can also view a company's availability for one-on-one meetings through the Schedule Meetings tab found on the conference platform. At this point, I'm very pleased to welcome Corey Diaz, co-founder and CEO of Anfield Energy, Inc., which trades on the OTCQB venture market under the symbol ANLDF and on the TSXV under the symbol AEC. Welcome, Corey.
Thank you very much. So thanks everyone for joining us. I'm here to talk about Anfield Energy. Anfield is a company with all of its uranium and vanadium assets in the United States. The company has a plan for near-term production of uranium and vanadium through its wholly owned Shooting Canyon Mill, one of only 3 licensed, permitted, and constructed conventional uranium mills in the United States. Safe harbor, read at your leisure. Capital markets profile, as mentioned, we trade both on the QB and the TSX Venture. Market cap is roughly $67 million Canadian. Our largest shareholder is Encore Energy, one of our peers. Uranium Energy is our second largest shareholder, and management and insiders hold about 4% of the shares. Red Cloud Securities provides research coverage to us, has a target of 20 cents per share in the company. Reasons to invest in Anfield. We've got a large portfolio of conventional uranium assets and vanadium assets in the United States, underpinned by the Shooting Canyon Mill. As I mentioned, it's a 750 ton per day conventional uranium mill, one of only 3 licensed, permitted, and constructed conventional uranium mills in the United States. We're strategically located within one of the most historically prolific production areas in the United States. So we think about the Four Corners. We have assets in Colorado, Utah, New Mexico, and Arizona. We have a mix of assets within our portfolio with current resource, historic resource, or past production. Those are the types of assets we target because we don't want to spend time with exploration. We acquired the Slick Rock project in 2022 from UEC through an asset swap. We had our assets in Wyoming, and we swapped those for Colorado-based assets, which fit perfectly into our portfolio, underpinned by a strategic production mill. And then finally, earlier this year, we acquired the Marquez Montefiore project in New Mexico from Encore. This also fits into our strategy of looking at both near-term production assets and secondary production assets, and we believe that our first foray into New Mexico through this acquisition will allow us to create an even larger secondary portfolio, which will give us a longer production pipeline. So the macro view on uranium, I'm sure many of you have been looking at the sector and understanding that there's a fair amount of geopolitical risk inherent in the sector. Obviously, we know what's happening in Russia. Russia is a leader in the conversion and enrichment side of the business, and a lot of the Western utilities would depend on Russian conversion and enrichment, which is at risk today. China is obviously getting closer to Kazakhstan, having the largest production profile in the sector. They're looking to create a trading hub on the border of China and Kazakhstan, which means that fewer pounds would flow westward for those U.S. utilities and Western utilities. There obviously was a coup in Niger not too long ago, which disrupted Orano's production, although the U.S. has stepped in to try to mitigate circumstances, and hopefully that will lead to a good outcome for Orano. And then finally, the U.S., with the largest nuclear reactor installed base, has virtually zero production coming from domestic suppliers at this point in time, which once again does create a risk for U.S. utilities in securing supply. That said, there is a nuclear renaissance taking place today. China, UAE, India, Eastern Europe are all building reactors and had reactors approved. Japan is restarting some of the reactors and looking to lift the cap on life extensions on some of those reactors, so going from 60 years to 80 years, which means more uranium is required. The USA has pledged a 200 gigawatt roadmap, which means that they'll be looking for additional 110 million pounds per year, which is a very, very large number. And then obviously earlier this year, there was a uranium reserve program, which acquired about 1 million pounds of uranium at an average price of $60 a pound. And that was about 20% above what the spot price was at the time. So, we wouldn't be surprised if there's a bifurcation in the market in terms of what the West will pay and specifically what the US will pay for pounds versus rest of the world. The supply remains an issue. Cameco supplying China Nuclear and Ukraine Energoatoms are removing material from North American market. We have financial players like Sprott, Yellowcake, coming into the market to acquire pounds out of the spot market, which leaves very little for the utilities to target. Kazatomprom has talked about reduction in its production forecast both for this year and next, and is also signing long-term contracts with China, which means that those pounds will not flow west. And then finally, we saw South Korea put out an RFP in September with a $58 floor and a $90 ceiling, and nobody was interested in supplying pounds with those kind of constraints. So I think that you can see overall with a demand increasing and supply tightening, the uranium price has only one direction to go, and that is up, which bodes well for the near-term producers or producers like ourselves. So in terms of the asset base that we're looking at, our primary production focus is in Utah and Colorado. Utah has both the Shooter and Canyon Mill and the Velvet Wood Mine. Colorado has Slick Rock and West Slope. Based on our most recent PEA, underpinned by Shooter and Canyon Mill, Velvet Wood, and Slick Rock, it returned an NPV of roughly $238 million US. And we're using a $70 uranium price in that projection. Obviously, the price is much higher today, and we'd expect by the time we're in production in the next 2 years or so to see that price move north of $100. So we'd expect that NPV to grow significantly. But you can see how our hub and spoke strategy, production strategy, is underpinned by Shootering. Shootering serves as the hub. Velvet Wood, Slick Rock serve as the first spokes, which would feed the mill. West Slope will be a secondary asset that would feed the mill once again, and we have other assets that could also complement our production plan. But in the near term, we're focused on Shootering, Velvet Wood, and Slick Rock. The core assets, as I mentioned, the pictures to the right, those are pictures of the mill, both close up and from a distance. We acquired this mill back in 2015 from Uranium One, 750 tons per day. Had run for about 4 months when it was constructed in the early 80s and then shut down because of low uranium prices. So it is there are very little, if any, environmental liabilities associated with the mill. The Velvet Wood Mine we acquired at the same time as we acquired Shootering. Historic production at the site of 4 million pounds of uranium and 5 million pounds of vanadium. The current resource on site is about 5 million pounds of uranium and roughly 7 million pounds of vanadium. This asset was included in the PEA, as I mentioned before. West Slope was acquired from Cotter Corporation back in 2018. It consists of 9 past-producing mines. Current resource, about 5.4 million pounds of uranium and about 27 million pounds of vanadium on 4 of the 9 mines. So we put a resource out on 4 of the 9 mines. The next 5 we'll put a resource out on in 2024, while we add economics to the first 4 mines on which we put resource already. So, as I mentioned, this is part of our secondary production plan, or a 1A production plan. And then Slick Rock, acquired through an asset swap with UEC back in 2022, where we traded our ISR properties in Wyoming for Slick Rock, which sits right next to some of our West Slope properties, a hard rock asset with both uranium and vanadium. In fact, it's a vanadium mine because it has about 6 times as much vanadium as it does uranium. The grades are decent. We did put out a resource, roughly 8 million pounds of uranium and about 47 million pounds of vanadium, and as part of our initial production profile. So the secondary pipeline, as I mentioned, Marquez Juan de Foya. This is our first foray into the New Mexico market. It is our largest single uranium asset at about 18 million pounds. The resource has no vanadium there. There was a PEA associated with the project that was commissioned by Encore a number of years ago, which turned an NPV of roughly $21 million at a 7% discount and a $60 uranium price. Of note, at $70, this NPV moves to about 73 million. So obviously, as it goes higher, it's highly leveraged to the price of uranium. So we think that the PEA would be significantly stronger once we delve back into the asset and look at the new returns based on a higher uranium price. Our aim is to use that as a secondary source on which we can build a pipeline in the, call it, 5 to 10 year range, and then continue to add more assets behind this in order to create a long life pipeline. We're looking right now at roughly 25 years of production, but as you produce, you want to make sure that you don't deplete your resource, so we'll look to continue to hold on to 25 years of pipeline as we move forward. So this is our first step in creating that longer pipeline. So the company's steps to production, as I mentioned, our near-term production plan is underpinned by the Shooting Canyon Mill, Velvet Wood, and Slick Rock. We do have a company called Precision Systems Engineering putting together a reactivation plan for the mill. We actually plan to submit our application for restart to the state of Utah in early 2024, which will start the clock ticking in terms of expectation of getting our license moved from its current standby position to operational. We believe that will be roughly 12 months, during which time we can start doing some of the refurbishment work required at the mill. And so we'd expect to be ready for production in 24 months from the time we submit the plan to the state. As I mentioned before, the NPV on our current PEA is $238 million, using a uranium price of $70. Obviously, the price is much higher than that today and expect it to move up. So once we're ready to produce, we'd expect to see a significant bump in our NPV. And then we're going to be adding a vanadium circuit to the mill because, as I mentioned, Slick Rock is more of a vanadium mine than it is a uranium mine. And so we'll capture that material, which will provide us another option in terms of revenue streams and potential other businesses, such as RF, vanadium flow batteries. Midterm, we'll be looking at the Slick Rock property. As I mentioned, there are 4 mines associated with Slick Rock. We put resource out on 4 of the 9 mines. We'll advance that to economics early in 2024, while we put resource on the following 5 properties. Our aim is to have this available to us as we start production and Velvet Wood falls off roughly year 8 or year 9. We'd have West Slope to fit in, slot in alongside Slick Rock, so we can have a production pipeline as it stands today of roughly 16 years for those sets of assets. And then longer term, to complement Marquez Montefoya, we have other portfolio assets, which include the Franken mine, which we acquired from Uranium One, Findlay Tank, Artillery Peak, which we picked up in Arizona, Marysville, another Utah property, and Calf Mesa, another Utah property. But we're always being opportunistic in the marketplace when it comes to looking for assets which complement what we hold already, with the understanding that we'll have a long-term production pipeline underpinned by the mill. So Velvet Wood, just a little bit of an outline. As I mentioned, we acquired this back in 2015 from Uranium One. There's historic production at site. There's lots of infrastructure, paved roads, grid power, water, 125 miles away from the mill. There's existing underground workings that we would open up in order to get production started again. And of note, our aim is to have both Velvet Wood and Slick Rock available for production roughly 18 months from the time that we do submit our application to the state. We'd like to be ready for production ahead of the time that the mill will be ready to accept the ore from the mines. West Slope acquired back in 2018 from Cotter Corporation, as I mentioned. About 1.3 million pounds of uranium was produced from site, about 6.6 million pounds of vanadium. Once again, the infrastructure is there. They're a historic asset, adits, underground stopes, open pit, lots of infrastructure. You can see the picture to the top right shows one of our mines, JD6. It's very open. In terms of getting these mines restarted, it would be very little capital costs because they are open and have recently produced. So from our perspective, this is a very easy path to get into production, add secondary production to our production profile. Then the Slick Rock property, as I mentioned, acquired from UEC through an asset swap. You can see in the picture on the top right, the green shape represents the Slick Rock property. The top blue shape actually represents one of our West Slope mines. You can see how close the proximity is to the Slick Rock property, and see how close these are and how we can potentially find ways to improve the economics of Slick Rock through the inclusion of some of our properties from West Slope. So peer comparison, always my favorite slide. This is in Canadian dollars, just so you know. A market cap of Anfield is roughly $67 million. If you look at the companies to the immediate right, the four companies to the immediate right of Anfield, so it's Energy Fuels, UEC, Encore, and UR Energy. All of those four have production facilities, much like UEC does, AEC does. However, you can see the market caps dwarf AECs quite significantly. The smallest of those trade at more than 8 times what AEC trades at. I don't know if that valuation is justified, but we do believe that we should be trading closer to being in line with at least the smallest of our peers. So that's a significant upside opportunity in terms of valuation, in terms of investment opportunity. The other three companies to the further right, none of those has a production facility that it owns. Peninsula did have a relationship with UEC, but that they're moving in their own direction now. Laramide is not producing, and Western does not have its own facility either. But yet, Western has a larger market cap than Anfield, and Peninsula and Laramide both have larger market caps. We believe that one of the reasons why we're not trading higher is that we're not as well known as the other companies, but we do believe that our portfolio does justify a significant uptick in valuation. And I'm sure, especially once we do announce that we have submitted our application to the state for restart, we should see a bump up in terms of valuation. So management directors, I won't talk about myself, but I think I'd like to highlight Ken Mashinsky. Who's had more than 30 years of nuclear-related experience working for General Atomics, based in California. It's a company that is a weapons defense manufacturer, but has a significant uranium portfolio. Ken was in charge of Quasar Resources, an Australian-based uranium company that produced 5 million pounds per year, and has significant experience both in sales and marketing of uranium, lobbying, government lobbying. I'm sitting on boards of various companies, including sitting on the management committee of Converdyn. So I believe that his experience as we move forward to production will be very important and critical. And then, when we look at our other board members, Don Falconer, more than 30 years of uranium experience, worked for Ontario Power Generation in the nuclear division, doing sales and marketing, has sat on boards of Energy Fuels and other companies, publicly traded, and has been the CEO of publicly traded companies too. So has another wide-ranging skill set that we find complementary to what we have within the portfolio already. So we do have a lot of experience in terms of the things that were required to move us from our current state to production, and we'll continue to look at adding to our board and management team as we move closer to executing on our production plan. And these are just other regional assets. Frankham and Finley Tank were assets that we acquired alongside Velvet Wood and Shooting Canyon Mill. They're not near-term targets, but certainly could be used for feed, to downgrade some material if required for Frankham. It's a low-grade deposit near the mill. And the Finley Tank pressure pipes, these are vertical resources as opposed to horizontal. So a special way to mine these. And so those aren't things that we're going to be looking at in the near term. There may be something we can address when we're well down the road from executing on our production plan. And that's the end of the presentation. So thank you for your time. Happy to take questions now. I'll just go through the list here. So question number one, are any of your projects brownfield? Yes, all of our projects are brownfield. We don't look at projects which are greenfield. We look at things that have an established resource or past production or current resource in place, because our aim is to move to production relatively quickly. Our mill will give us production opportunity within 2 years. The mines that I've highlighted, both Velvet Wood and Slick Rock, will have up and running and ready within 18 months. Question number two, what is your relationship with Encore? We have a very strong relationship with Encore. We've known Bill for a number of years and Paul. We did acquire a property from Encore earlier this year, and we've been in discussions over a myriad of ways to work together going forward. We believe that Encore has a very strong management team. We love what they're doing in terms of getting themselves up and into production. We applaud that. We think that we need more production in the sector, and certainly we like to see others being successful. And so, we'll continue to have a strong relationship with Encore, and Encore still has other hard rock assets which I don't necessarily think fit into their current portfolio as we move forward in ISR production. So that may be an opportunity for us. Third question, why do you think you traded at a discount to peers, and what are catalysts for a re-rating of Anfield? Well, look, as I mentioned, I think that we trade at a discount, not justifiably, but I think we're probably not as well known as our peers. I think that's the first thing. But I do think that when we do announce that we've submitted the application for restart to the mill, I think we'll see a restart at that point, because that gives us a timeline and a clock by which we can be judged, i.e. we'll be in production, call it late 2025, early 2026. So it gives a timeline, by which we'll be in production. So I think that's important. I think that there will certainly be other catalysts within the sector. That means moving the mines forward. It means acquiring new assets. It means starting work at the mill. There'll be a number of things that we believe will help us get re-rated and improve our visibility and certainly improve our valuation. Sorry. What is your capital position and your 2024? Are your 2024 programs funded? Look, we have roughly $1.5 million in our till. Our programs are funded to the extent that we need them to be funded. So the more money we have in our till, the more we can do, i.e., acquisitions, advancements of both Velvet Wood and Slick Rock, potentially Marquez Montefoya, West Slope. The bottom line is, the more money we have in the till, we can start doing work at the mill itself. We can start demolishing some areas that won't be required as we move forward. We're also looking at expanding the size of the mill's capacity from its current 750 tons per day to about 1,000 tons per day, because we have significant resource that can go through the mill. We're also looking at expanding our licensed capacity for production on an annual basis from its current 1 million pounds per year to close to 3 million pounds per year. So it all depends on how much money we have in the till and how quickly the output, the speed of the output will be based on the amount of money we have inside. So down the road, I'm sure we'll look to go back to the market to raise money. That's the general nature of a pre-revenue company. But obviously, the more money we have within our bank account, the more quickly we can get work done. Oh, another question. Can you access any of the IRA incentives? So we can. There's money both at the DoD for mine-related purposes, and there's money at the Department of Energy, so DOE, for mill-related, processing-related opportunities. So we are in discussions with both And obviously, given the strategic nature of both uranium and vanadium, we believe that there's a big opportunity to secure funds from both departments. And so, we'll continue to have those discussions with both departments when we're as we advance the mill and the mines forward to production. Well, I have no more questions. So once again, I want to say thank you for taking the time to sit through my presentation, and feel free to reach out should you have any further questions.